On December 22, 2025, spot gold jumped more than 2% and printed a fresh all-time high around $4,442 per ounce. In human terms, that is not a chart move, it is a siren. Screens across retail land start stuttering. The buy button flickers, the cart freezes, and then you get the quietest sentence in finance. No quote. We are told the price is the price. Spot is the truth, a clean number that belongs to everyone. But in the real chain, the number you can actually execute is an all-in price, and the all-in price is a living animal. It has teeth, and it bites hardest when the market moves fastest. Dealer, wholesaler, mint or refiner, buyer. 4 roles, 1 fragile clock, and 1 ugly question. When the tape screams, who is still willing to promise delivery? By October 22, 2025, gold had already punched through $3,000 per ounce in March and $4,000 per ounce in October. It looks like a simple climb, but it is also a stress test. Those round numbers are where demand surges, headlines stack up, and the flow of orders becomes a stampede. In that stampede, the paper price can print instantly while the physical chain has to breathe. On October 20, 2025, Reuters reported that spot gold had just hit an all-time high of 4,378.69, then closed 1.8% lower the same day. Here is the translation. The market can take the same price and swing it hard within hours. That swing is the gap between a dealer saying yes and a dealer staying alive after saying yes. I will show where the switch is. JM Bullion says that once you advance to checkout, your prices are held for 10 minutes, and if you take longer, you have to approve new updated prices before finalizing. Which means the clock is not a metaphor, it is a policy. If you hesitate, the price you thought you had becomes a question again, and the dealer has a legal path to reprice without apologizing. And that is the line people keep missing. The headline spot price only matters when it can clear and deliver. COMEX described adjusting its lock in period from 10 minutes to 5 minutes during the COVID shock, specifically because spot prices were changing quickly. Picture the scene. The timer gets cut in half not because someone is impatient, but because volatility is eating the margin like fire. When the market runs, the dealer shrinks the window, because the window is where losses breed. COMEX also tells customers their payment must be received within 3 business days or 5 business days for paper checks to guarantee the price. It looks like a payment reminder, but it is really a risk boundary. A dealer is not only selling metal, the dealer is financing your delay, and the dealer refuses to do that for free when the market is whipping. SD Bullion states in its terms that when an order is confirmed, prices become locked in and the order becomes a contractually binding agreement, and cancellations can incur operational, hedging, or market loss fees. In practical terms, the moment the order locks, both sides are trapped by the hedge. That is why the dealer gets angry when people treat a locked order like a shopping cart they can abandon without cost. Now comes the part everyone wants to simplify into greed. People stare at a widening premium and say the dealer is just gouging. That story is soothing because it gives us a villain we can hate and ignore. But the system does not care what we feel. The dealer is a thin shock absorber between the buyer and a market that can move hard in minutes. You do not get hurt by spot alone. You get hurt by the gap between confirm and delivered. A COMEX gold futures contract is 100 troy ounces. Direct translation. 1 click in the hedge world represents a stack of metal big enough to make a retail order look like lint. Dealers lean on that market because it trades fast. That speed is also a trap, because the hedge reprices faster than the physical supply chain can restock. A COMEX silver futures contract is 5,000 troy ounces, which means you cannot neatly hedge a handful of retail tubes without touching a very large instrument. In consequence terms, the hedge is chunky. When silver goes wild, the dealer either eats basis risk, widens the retail spread, or stops quoting until the chain stops shaking. CME Group says gold futures trade the equivalent of about 27 million ounces per day, roughly 30 times the SPDR gold ETF at about 0.8 million ounces per day. It looks like endless liquidity, but it is a different universe. In the paper universe, size trades all day. In the physical universe, a wholesaler has to locate bars. A mint has to allocate production, and the dealer has to ship without getting robbed or delayed. The LBMA gold price continues to be set twice daily at 10:30 and 15 o'clock UK time. Here is the translation. Even the benchmark for London gold has scheduled moments where the market gathers to settle on a number. Physical pricing leans on benchmarks and feeds, but retail orders arrive in a constant stream. When the feed moves too fast between benchmarks, the dealer is forced to protect the promise, not the number. The US Mint says it does not sell American Eagle bullion coins directly to the public, which means the retail buyer is always downstream. You are not buying from the source, you are buying from the chain. And every link in that chain takes a slice, adds rules, and most importantly adds time. The US Mint also states it was accepting applications for gold bullion authorized purchasers through December 31, 2025, while American Eagle silver bullion remained on allocation and the application process for silver bullion authorized purchasers was suspended. Mini-scene. Allocation is the polite word for rationing. When allocation shows up, the wholesaler stops promising quantities. The dealer stops promising delivery windows, and the premium becomes the only honest way to slow demand without lying. So when we see no quote, we are not seeing a website glitch. We are seeing the dealer admit something the marketing pages never say out loud. The all-in price is not just spot plus a tidy markup. It is also inventory confidence, hedge confidence, and delivery confidence, all jammed into one number that has to survive the next 5 minutes. This is why the night everything broke feels personal. We refresh, and the screen refuses to commit. We tell ourselves it is unfair, because spot is right there, clean and public. But the chain is not public. The chain is a set of contracts, clocks, and penalties, and the dealer lives inside that cage every time the market spikes. When premium speaks louder than spot, it is not a slogan, it is the sound of risk being priced in real time. You can ignore it, but you will pay it anyway. The screen went no quote because the system chose survival over courtesy. The moment the market starts whipping intraday, the chain stops pretending it can promise everything to everyone at the same time. We need a clean map because the industry sells a fairy tale. The fairy tale says, spot moves, price follows, you buy, metal arrives. The real map is harsher. Dealer is the storefront and the shock absorber. Wholesaler is the reservoir of inventory and two-way flow. Mint or refiner is production capacity, measured in days and weeks, not seconds. Buyer is the one who thinks a checkout click is a commitment from the universe. When intraday volatility spikes, the weakest link is always the promise between confirm and deliver. Start with what a quote really is. A quote is not a number. A quote is a bundle, all in price, quantity, and a time window where the dealer is willing to be bound. That time window is the fuse. We saw retail platforms hold a checkout price for 10 minutes, and in stressed periods some cut that to 5. Here is the translation. The dealer is not giving you convenience. The dealer is buying themselves a chance to hedge and source before the market runs away. Shorten the fuse, shrink the loss. Now look at the margin reality. Amark Precious Metals reports a direct-to-consumer gross margin of about 5.721% for the year ended June 30, 2024, and a wholesale sales gross margin under 1% in the same period. It looks like a healthy business because revenue is huge, but it is mostly throughput. In consequence terms, one ugly intraday move can erase weeks of clean work if the dealer cannot keep the book flat. Amark also reports direct-to-consumer ticket volume of 613,739 orders in fiscal 2024. So how does the dealer normally survive? By neutralizing commodity price risk almost immediately. Amark describes using forward sales transactions to hedge commodity price risk and says it does not enter into those forward sales for speculative purposes. It looks like paperwork, but it is the spine of the whole machine. The dealer wants to be flat. Sell you metal, hedge the metal exposure, then unwind the hedge when the physical metal is delivered or sourced. The numbers inside that hedge tell you why quotes disappear. As of June 30, 2024, Amark shows precious metal subject to price risk around $929.1 million, and derivative financial instruments tied to metals around $926.7 million, leaving net metal subject to commodity price risk around $2.474 million. In practical terms, the goal is not to guess gold. The goal is to make the exposure almost zero. When the dealer cannot make it almost zero fast enough, the dealer does not quote. The same report shows open forward contracts around $843.4 million and open futures contracts around $83.214 million at June 30, 2024. That is not a side activity, that is the plumbing. It also means that plumbing depends on markets staying liquid enough to hedge in seconds. When liquidity thins or price gaps, the plumbing rattles. That is when the no quote sign goes up. Here is where intraday volatility becomes a physical problem. A COMEX gold futures contract represents 100 troy ounces, and the minimum tick is 10 cents per ounce, or $10 per contract. It looks small, but fast markets do not move in one tick. They jump in tens of dollars. A $30 move is 300 ticks, or $3,000 per contract. A few seconds of delay can turn a normal spread into a real loss, especially when you are trying to hedge thousands of retail ounces moving through the cart. We are still not at the heart of the pain. The heart is the gap between what the dealer sees and what the dealer can actually lock. The dealer can hedge paper fast, but the dealer cannot conjure physical. If the dealer is quoting from on-hand inventory, the problem is manageable. If the dealer is quoting from expected replenishment, the problem turns violent. This is where the wholesaler becomes the spotlight. The wholesaler is the one feeding availability and replacement cost. When the market is calm, wholesaler quotes are tight enough that the dealer can publish an all-in price with a reasonable premium and sleep. When the market gets jumpy, wholesaler behavior changes first. The wholesaler widens spreads, shortens the valid window, caps quantity, and sometimes simply stops giving firm prices for a few minutes. The dealer is not being dramatic when the buy button vanishes. The dealer is reacting to the reservoir going unstable. You can feel this through the policies, even when the sites do not say the quiet part out loud. Some dealers require a bank wire for orders above $20,000, and some require the wire to be received within 72 business hours. Consequence first, that is where the trap closes. Large orders are the ones most likely to be placed in panic, and they are also the ones with the most payment friction. The dealer is sitting on risk while money moves through banking rails that do not care about your urgency. And then there's the contract side, the part people pretend does not matter. Many dealers describe locked orders as binding contracts and reserve the right to assess market loss or cancellation fees if you walk away. It looks like punishment, but it is the hedge talking. Once the dealer locks an order, they hedge. If you cancel, the dealer unwinds the hedge, and that unwind can be a loss. The fee is not always about profit. It is about keeping the system from being used as a free option. This is why intraday volatility turns premium into the real executable price. In a fast market, the dealer does not fear the spot number on your screen. The dealer fears the next print while the hedge is still filling, while the wholesaler is repricing, while the mint or refiner is on allocation, and while the shipping promise is still hanging in the air. It looks like spot is the anchor, but the anchor is the ability to replace inventory at a known cost. When everything is normal, you see a stable premium and a clean all-in price. When everything is stressed, you see 4 moves at once. Quote TTL gets shorter, spreads get wider, quantity limits appear, pre-sale delivery windows stretch. And when those 4 moves are not enough, the dealer stops quoting because quoting is agreeing to be trapped. You can hate that. It still stays true. No quote is the dealer refusing to sell you certainty they cannot buy back. It is the storefront admitting that the reservoir cannot be trusted for the next few minutes. It is the mint or refiner reminding the chain that production time does not compress just because the chart is moving. And it is the buyer learning the hardest lesson in this market. The price that matters is the one that clears, locks, and ships. No quote is the most honest thing a dealer can do, and it still feels like betrayal. We stare at spot and think the market owes us a price. The chain does not owe us anything. The chain only moves when someone is willing to sign their name to an all-in price and then live with what happens next. On December 22, 2025, spot gold printed another record high, with Reuters reporting an intraday peak at $4,445.69 per ounce in early Asia trading. Here is the translation. Even the safest asset in the room is moving fast enough to break retail routines. In that same wave, gold was up about 67% in 2025. It looks like a victory lap, but it is also a stress multiplier. Every percent of upside pulls more buyers into the same narrow doorway, and the doorway has a timer. We can watch the timer shrink in plain text. Bullion says prices are held for 10 minutes once you advance to checkout. Then you must approve updated prices to finalize. This looks like a customer feature, but it is a dealer defense mechanism. The checkout clock is the dealer trying to outrun a moving market and a moving wholesaler feed at the same time. When the chart speeds up, the clock becomes the real price. APMEX documented this in 2020 when it cut the price lock-in period from 10 minutes to 5 minutes during rapid spot changes. That move is not ancient history. It is a blueprint. When volatility spikes, the system tightens its grip. Shorter time windows, stricter payment deadlines, harsher cancellation terms. The storefront starts acting like a risk desk because it is one. Then we hit the part that wrecks people. Money gets locked before metal gets delivered. APMEX says payment must be received within 3 business days or 5 business days for paper checks to guarantee price. Consequence first. This is where the trap closes. The market can move against you while the bank system pretends it is still 1997. The dealer is not waiting for your feelings. The dealer is waiting for cleared funds because cleared funds is the only thing that makes a hedge survivable. Now add the penalty layer. APMEX spells out a market loss policy that can charge the market loss plus the greater of $50 or 5% of the order total for cancellations or returns. SD Bullion says cancellation fees are 5% of the order total or $35, whichever is greater, plus any applicable market loss, defined as the difference between the locked spot price at order time and spot at cancellation time. It looks like a punishment, but it is the cost of unwinding a hedge in a market that is still moving. When people say they only clicked buy, the contract language answers back, you clicked a binding exposure. And the fees are not the only consequence. The physical chain can refuse to pretend that supply is smooth. On October 15, 2025, El Chorrito Coin Exchange posted that due to extreme volatility and supply and premium changes by wholesalers, prices would not be updated on the site, and multiple items showed call for pricing. Mini-scene. That is no quote in a suit. The wholesaler input becomes unstable, so the dealer output disappears. The buyer sees a blank where a number used to be. The system is telling us that premium is not decoration. Premium is the throttle. We should be furious at how the story is sold. The marketing pages sell spot as a public truth. The terms pages sell time as a private weapon. That mismatch is where retail gets crushed. We pay attention to the number and ignore the conditions that decide whether the number can be honored. The system counts on that ignorance. It keeps the checkout page clean and hides the risk and policy tabs. Under the hood, the dealer is not swimming in margin. The A-Mark Fiscal 2024 Annual Report shows direct-to-consumer gross margin at 5.721% and wholesale sales and ancillary services gross margin under 1%. In practical terms, this is a throughput business with thin error tolerance. So the dealer builds a machine to stay flat. In the same annual report, A-Mark shows precious metals subject to price risk around $929.127 million as of June 30, 2024, and derivative financial instruments around $926.653 million, leaving net precious metals subject to commodity price risk at $2.474 million. It looks like magic, but it is a daily grind. The report says the company adjusts the carrying value of derivatives to fair value on a daily basis until transactions are physically settled. Translation: the hedge book is a living thing that must be fed every day. If the hedge cannot be fed fast enough, quote stop. This is also why premium can widen even when spot is calm for a moment. The premium is not only a metal price. It is a risk price for everything that can go wrong between now and delivered: wholesaler repricing, allocation, production lag, shipping delay, fraud risk, chargeback risk, and the simple fact that a future screen can move faster than a pallet. CME Group bragging is instructive here. Gold futures trade the equivalent of about 27 million ounces per day, about 30 times the SPDR Gold ETF at about 0.8 million ounces per day. It looks like liquidity, but it is paper liquidity. Physical liquidity is measured in inventory and truck schedules. The survival warning is simple and ugly. If we keep treating checkout like a casual click, we will keep paying like amateurs. You do not get to buy certainty at the spot price during a volatility spike. The system will sell you certainty at an all-in price, or it will refuse to sell it at all. So what do we do with this in 2025, when premium speaks louder than spot and no quote shows up like a slammed door? We stop worshiping the headline number. We evaluate the whole package: all-in price, quote TTL, payment deadline, cancellation terms, and realistic delivery window. We keep funds ready before we shop, not after. We assume the timer will shrink during stress because the timer always shrinks during stress. And we remember what the chain is actually saying when the button vanishes. Not now, Not at that risk, not on that clock. That is how the loop closes. The night everything broke was not a glitchy website. It was a system choosing not to die for our convenience. The anger is justified, but the lesson is mandatory. In this market, the executable price is the price that survives the clock and arrives at the door.